Dennis, when you think about clients who've been the most successful with their financial planning over time, what qualities do you think they share?
Well, I think they are engaged. That's the first thing. They appreciate what their own limitations are around their knowledge and what they can do, but they're not necessarily just shoving the whole thing off on somebody else. They take an interest in their money, not for the money's sake, but what it can do for them. That is one. I think also realism. So they're not looking to make quick buck. Well, we're all looking to make a quick buck maybe, but they're not looking for that as their financial plan. It's the ability to save first and spend second.
That's a very good saying. So we're sort of touching on investing there, and what makes a good investor. So good investing, is that more about knowledge or behavior?
I think both come into the mix, but behavior is far more important in my experience. And there are libraries. I've got a library full of books about behavioral investing. And it's those poor behaviors that trip people up. Good behaviors are quite easy, really, once you know what they are.
Mm.
And it's about having patience and, again, I suppose, just understanding that over the long term, even professional money managers are not able to outperform and beat the market. So if you can accept that, and it's the acceptance, if you can accept market returns over the long term and then invest that way, one, you'll save a heck of a lot of money. Two, a lot of heartache. And three, you'll probably get to where you want to be.
Okay, you mentioned patience there. How important is patience, particularly when markets are getting a bit choppy?
So what people feel they want to do, what people believe that professionals might be able to do, is to time the peaks and troughs of the market. So they'll be able to get out at the top and buy in at the bottom. And that would be a lovely thing to do. But I've got a graph of people where their behaviors are completely the opposite. And they go through this curve, this sine wave, where they buy at the top because that's when the markets are the most frothy and everyone's feeling very buoyant and confident and they want to get in. I had an email this morning about somebody wanting to invest right now because the markets are up 4% over the last week. So that's what people do. And then the market falls and they hang on and it gets almost to the bottom and say, well, I've been hanging on so long. The market is never going to recover. And then they sell. And they repeat that cycle until they're broke, basically. And really, it should be the other way around. In fact, really, you should just buy and say that I'm investing for my lifetime. This money is going to be working for me for the next 30, 40, 50 years. So trying to time all the intermediate little short-term movements in the market is not a good use of my time. I'm not going to be very good at it. Why don't I just accept that on average, the market will deliver for me about 8% a year. And the only thing I can control is how much I'm paying for that investment expertise.
Well, we can come back to that. So apart from that big mistake you've just described, are there any other common mistakes that investors make that you see time and time again and that we can help people avoid?
Over concentration in certain areas. I'm going to follow tech stocks this week. I'm going to follow internet stocks in the road to 2000. I'm going to follow whatever it is. People who think that they can spot the next big opportunity. And you might, but can you consistently do that over your entire lifetime? It's a bit like that timing the market thing. You might get it right once, you might get it right twice, and then you think you're a gift to the investing world, but you're not, because the evidence shows us that even professional money managers might get it right over a 1 to 2 year period. But you look at how many of them get it right over a 10 or a 15-year period, and it falls to under 10% of managers have been able to consistently outperform the market over a decade or more. And the problem is, you've got to know which manager it is at the beginning, not at the end.
Okay.
Right.
Okay. So you touched on cost there, and I think that's really, really important that we raise that, because I know it's something that you feel very strongly about and you want people to understand. So what are the cost implications when it comes to investing?
There's only one thing we can control. Well, there's a couple of things we can control. One is that we can control whether we're going to be patient or reactive to the market. Just buy it, but once you buy it, hold it. But make sure you buy it at the right cost.
Okay, what does that mean?
Well, you can buy, any old manager out there wants to charge you 1% a year for essentially trying to track an index, or you can do it for a fraction of a percent. And if you do it for a fraction of a percent, that's money in your pocket. You've kept it. The only thing you can control really is how much you pay. You can't control inflation. You can't control market sentiment. You can't control taxes. You've got no control over the government. Even if you vote, you've got no control over the government. The only thing you can control is how much you're going to pay. And the real value, if you're paying for anything at all, it's for the plan. And we've mentioned this before. Pay for the financial planning, not for the investment management, because they can't do it. They're bloody useless.
Okay, we're getting quite controversial here.
We are, but this is what we stand for.
Okay, brilliant. I love hearing all of that. So we talked about common mistakes. We've talked about cost. I think that you've given people a really good idea of what they should and shouldn't be doing. But in a nutshell, if someone wanted to become a better investor, where should they start? I mean, should they start with mindset or method?
Mindset. Really. I mean, the method is you're still going to save more than you're saving, especially young people. Save more than you're currently saving, spend less than you're spending, because life is going to be long and it's probably going to be more expensive than you thought it was. But then once you've made that decision to invest, buy the fund and then ignore it. Leave it alone. Let it get on with its job, basically.